Picture the moment you signed the papers on your mortgage, the pen, the stack of documents, the handshake. Somewhere, probably in an office you never visited, in a building you never knew existed. That piece of paper, your piece of paper, was being bundled with 10,000 others just like it. Packaged, rated, sold, and sold again. That is where this story begins. Not in a courthouse, not in a boardroom. In the quiet hum of a machine that almost nobody understood, built on the fourth floor of a glass tower at 745 7th Avenue in Midtown Manhattan, 38 stories above Times Square, ticking forward like a clock that had no alarm. The name on the building said Lehman Brothers. Most people who walked past it had no idea what happened inside. They knew the name vaguely, the way you know the name of a pharmaceutical company or an insurance firm, something serious, something financial, something that made enormous amounts of money for people who wore good suits. What almost nobody knew until one Monday morning in September 2008 was that the machine inside that tower had already stopped. At 1:45 in the morning on Monday, September 15, 2008, Lehman Brothers Holdings Inc. filed for Chapter 11 bankruptcy protection. The firm declared $639 billion in assets against $613 billion in debts. It was the largest bankruptcy filing in the history of the United States. It remains so today. At its peak, the firm employed 26,200 people across offices in 27 countries on every inhabited continent. It had survived the American Civil War, survived the Great Depression, survived 2 world wars, the oil shock of 1973, the bond market crisis of 1994, the Russian debt default of 1998, and the destruction of its Lower Manhattan offices on September 11, 2001. For 164 years, through the most violent economic storms the world had produced, Lehman Brothers had not just survived, it had grown. And then, in the space of 12 months, it was gone. How does one of Wall Street's most storied institutions, a firm that had navigated more than a century and a half of financial catastrophe, collapse in a single year? And what was actually happening inside those walls in the final months when the people running the firm knew it was dying and told no one? Those are the 2 questions that have never been fully answered. We are going to answer them now. If you're finding this story compelling, leave a comment below. We want to hear what you already knew about Lehman Brothers and what surprised you. And if you haven't subscribed yet, now is the moment. Every week we tell stories like this one, stories that were too complicated for the news cycle, too long for a headline, and too important to be forgotten. Chapter 1. The Cotton Man from Rimpa. His name at birth was Hayum Lehman. He was born on September 29, 1822, in the village of Rimpa, in Bavaria, a small agricultural town about 5 miles north of Würzburg. His father, Abraham, was a cattle dealer, a man who worked with his hands and lived by the rhythms of the market and the seasons. The family was Jewish, part of the tight-knit community of rural Bavarian Jews who had been buying and selling livestock and commodities for generations. In Rimpa, the rules were clear. As the oldest son of Abraham Lehman, Hayum stood in line to inherit his father's right to live and work in the village. But that right was not transferable to younger sons. Emmanuel and Maya, the brothers who would come after him, would need to find their own way in the world. Lehman chose America. He arrived in New York Harbor on September 11th, 1844, at the age of 21. He anglicized his name to Henry Lehman, discarded the second N from the surname, and within weeks had sailed south again, this time for Mobile, Alabama. He spent the next year traveling the waterways of the Alabama River, a peddler with a wagon of dry goods, learning the rhythms of the cotton economy of the antebellum South. What he saw on Mobile's docks was the entire logic of the age compressed into one image. Bales of raw cotton going out on ships bound for the textile mills of New England and Lancashire, and finished goods, cloth, tools, seed, crockery, coming back in on smaller vessels headed upriver. The South produced the raw material, the North and England processed it. The men in the middle, the brokers and the merchants, made the margin. Henry Lehman understood margins. By 1846 or 1847, he had settled in Montgomery, the new state capital of Alabama, and opened a small store on Commerce Street. He styled himself a grocer at first, a dealer in general merchandise, selling dry goods, seeds, glassware, cotton fabrics, coarse cloth known as Osnaburgs. He lived in the building. It was business and residence and warehouse in one. In 1847, his younger brother Emmanuel joined him, changing the sign above the door to H. Lehman and Bro. They moved to larger premises at number 17 Court Square, a building they eventually earned enough to buy outright. In 1850, the youngest brother arrived. Meyer Lehman, 20 years old, had made the same transatlantic crossing his brothers had made before him. With all three together, the firm became Lehman Brothers. The name that would one day stand on the most consequential corporate bankruptcy in American history was first spoken above a dry goods store in Montgomery, Alabama, in a year when Abraham Lincoln was an obscure one-term congressman from Illinois, and the cotton fields of the South stretched to the horizon in every direction. The cotton was the revelation. Alabama's planters needed credit and supplies. The Lehmans needed product. They began accepting cotton bales in payment for merchandise. By 1852, they were extending credit to planters, settling accounts in cotton more often than in cash, and buying and selling real estate on the side. The gap between selling dry goods and trading commodities was shorter than it appeared. Both required you to know the price of things, to buy low and sell high, and to extend trust judiciously. Emmanuel traveled to New York each year to replenish supplies and negotiate with cotton manufacturers. Meyer stayed in Montgomery, managing the planters and the farmers, building the relationships that generated the bales. According to family tradition passed down through generations, Meyer made the money. Emmanuel made sure they didn't lose it. Henry Lehman died in New Orleans in November 1855 at the age of 33 of yellow fever. He had been in the city on business. Emmanuel and Meyer buried their brother and returned to Montgomery and kept going. Because that was what the Lehmans did. They kept going. By 1858, Emmanuel had moved permanently to New York and opened a branch of Lehman Brothers at 119 Liberty Street in Lower Manhattan, just a few blocks from the future site of the New York Stock Exchange, and within walking distance of the streets where the Goldman, Sachs, Kuhn and Loeb families were beginning their own ascents. The cotton brokerage now had two addresses, Montgomery in the south, New York in the north. The timing was, to put it gently, unfortunate. 3 years after Emmanuel moved north, the American Civil War began. Chapter 2: Fire, Reconstruction, and the Making of Wall Street. The war almost ended everything. Montgomery was the first capital of the Confederacy. Mayor Lehman, who had built deep ties with the planters and merchants of Alabama, was a supporter of the Southern cause. Emmanuel in New York watched the union he had just joined tear itself apart. The cotton trade, the lifeblood of everything the brothers had built, collapsed. The networks of credit, the relationships with planters, the pipelines of bales moving north, all of it disrupted, then destroyed. But the Lehmans did not close. Meyer stayed in Montgomery through the war, navigating what commerce was possible, keeping the firm's name alive in the South. Emmanuel in New York kept the northern operation functioning. When the guns fell silent in 1865, they did what survivors do. They adapted. They moved the center of gravity north permanently. New York was now unambiguously the financial capital of America, and the brothers understood, with the instinct that had served them since Bavaria, that this was where the future lay. They shifted their focus from spot trading in physical cotton to the new world of commodity futures, and in 1870 they co-founded the New York Cotton Exchange, the first commodities futures exchange in the city's history. Meyer Lehman was appointed to its first board of directors. The firm had just survived a war that destroyed the entire economic basis of everything it had been built on. And it had emerged within 5 years as a founder of the most important commodity exchange in America. In 1887, Lehman Brothers joined the New York Stock Exchange. The transformation from dry goods merchant to commodity broker to securities firm was complete. The peddler from Rimpar's son had become a Wall Street institution. The next pivot came in 1906, when Lehman Brothers formed an alliance with Goldman Sachs, at that time a similarly ambitious German Jewish immigrant firm building its own reputation on the street. Together, Philip Lehman, Emmanuel's son, and Henry Goldman of Goldman Sachs became the dominant partnership in underwriting securities for the great names of American retail: Sears, Roebuck and Company, F.W. Woolworth, R.H. Macy's, the May department stores, Gimbel Brothers. When the stock market crashed in October 1929, and the Great Depression began to strangle the global economy, Lehman Brothers survived by pivoting again. Under Robert Lehman, the grandson of Mayer, who took control of the firm in 1925 and would lead it for 4 decades, the company shifted from conventional underwriting to venture capital, backing new and speculative industries that established firms wouldn't touch. Robert Lehman financed film studios, RKO Pictures, Paramount, 20th Century Fox. He backed airlines and radio networks. While other firms suffered catastrophic losses, Lehman found the industries of the future and put money into them. Robert Lehman led the firm through the Depression, through the Second World War, through the Korean War and the Cold War, through the oil shock of 1973. He died in 1969 after 44 years at the helm, the last member of the family ever to lead the company. Under his leadership, Lehman Brothers had survived every crisis the 20th century had thrown at it. After Robert's death, the firm entered a turbulent period. Internal conflicts between investment bankers and traders nearly destroyed the partnership from within in the late 1970s. In 1977, Lehman merged with Kuhn, Loeb and Company, another venerable Wall Street house, in an attempt to consolidate its position. The internal warfare continued. In 1984, under duress and after years of internal power struggles, Lehman Brothers was sold to American Express, the credit card and financial services giant, for $360 million. For 10 years, the firm operated as a subsidiary of American Express, stripped of its independence, its identity subordinated to a parent company that never fully understood what it had bought. Then, in May 1994, American Express spun Lehman Brothers off as an independent public company, listing it on the New York Stock Exchange. The man they chose to lead the newly independent firm was a short-tempered, intensely competitive, deeply loyal career Lehman man who had joined the firm's fixed income division in 1969. Fould's personal compensation told the same story. Between 2000 and 2007, he received a total compensation package measured at somewhere between $350 million and $484 million. His name was Richard Severin Fould, Jr., and the next chapter of Lehman Brothers, its most spectacular and its most catastrophic, belonged entirely to him. Chapter 3: The Gorilla and the Golden Years. Richard Fould had been at Lehman Brothers for 25 years by the time he was named chief executive in 1994. By 2006, the numbers bore him out, at least on their face. Lehman Brothers posted net revenues of $17.6 billion for fiscal year 2006. Net income hit $4 billion. The stock, trading at around $60 a share, had risen more than tenfold since the IPO in 1994. The firm's return on equity was running at over 20%. Fould took control of an independent Lehman Brothers at a difficult moment. The 1994 bond market crisis, triggered when the U.S. Federal Reserve raised interest rates 7 times in 12 months, had sent shock waves through fixed income markets worldwide and hammered Lehman's core business. In his first quarterly earnings statement as CEO, Fould reported net income of just $20 million. The survival of the newly independent firm was not guaranteed. He recruited aggressively. He instilled a culture of intense loyalty, loyalty to the firm, loyalty to the team, and above all, loyalty to him. Dissent was not encouraged. Those who disagreed with Fould's direction tended not to stay long. Through the late 1990s, Lehman's revenues climbed. The firm handled some of the defining transactions of the decade: major corporate bonds, leveraged buyouts, emerging market debt. When long-term capital management, the hedge fund staffed by Nobel Prize winners, imploded in 1998 and nearly took the financial system with it, Lehman survived. When the dot-com bubble burst in 2000 and markets collapsed, Lehman survived. When Al-Qaeda destroyed the World Trade Center on September 11, 2001, and Lehman's offices at 3 World Financial Center, just across the street, were damaged and forced to evacuate, the firm relocated within days and kept trading. Each survival made Fould more convinced that he and Lehman were indestructible. In the league tables of Wall Street, Lehman was ranked 4th among American investment banks, behind Goldman Sachs, Morgan Stanley, and Merrill Lynch, but ahead of Bear Stearns and breathing down the necks of everyone above it. Fould's personal compensation told the same story. Between 2000 and 2007, he received a total compensation package measured at somewhere between $350 million and $484 million. The engine behind those numbers was a machine that Lehman had been building for a decade. A vertically integrated mortgage business that originated home loans, packaged them into securities, and sold those securities to investors around the world. In 2003, the firm acquired Aurora Loan Services and BNC Mortgage, LLC. Lehman now controlled the entire pipeline. From the moment a borrower in Phoenix or Miami signed their loan application, to the moment a pension fund in Oslo or Osaka received a bond backed by that loan. In 2005 and 2006, Lehman was the #1 underwriter of subprime mortgage-backed securities on Wall Street, packaging and selling nearly $52 billion in subprime MBS in 2006 alone. The machine was running at full speed. The commissions were extraordinary. The bonuses were extraordinary. The share price was extraordinary. The word risk does not appear to have been spoken very loudly in Fould's inner circle during those years. Chapter 4. The First Cracks. He told them in 2005. Not publicly. Not in a press release. In a meeting on the trading floor, Mike Gelband, the global head of Lehman's fixed income division, one of the most respected figures in the firm, gathered a group of distressed debt traders and told them something that no one at the senior level wanted to hear. He told them, in direct terms, that the firm was carrying dangerously high levels of debt, that the leverage ratios were unsustainable, and that the housing market could not keep climbing forever. He was ignored. In late 2006, as the first serious cracks appeared in the subprime mortgage market, Gelband escalated. He went directly to Richard Fould and told him, "The world is changing. We have to rethink our business model." Fould's response was dismissive. "You're too conservative," he told Gelband. In the words of a former senior trader, Gelband said to highly respected people, "You guys realize this is like going to the electric chair." Fould chose not to side with Gelband. He said, "Don't tell me why we can't do things. Tell me why we can." Gelband left the firm in 2007. So did Larry McCarthy, the former head of distressed debt trading, who had been raising the same alarms. Andrew Gowers later told The Observer that it was quite hard to stand in the way. Lehman had good risk managers, but the prevailing atmosphere was for fast growth and special fast-track treatment for what we now know were toxic deals. The detail that never made the headlines was this. Lehman's Risk Management Committee, the body responsible for overseeing the firm's exposure to dangerous positions, met only twice in 2006 and only twice in 2007. The committee that was supposed to be the firm's early warning system was, effectively, dormant during the 2 years in which the dangers were growing most rapidly. In August 2007, Lehman Brothers closed BNC Mortgage, LLC, its subprime origination subsidiary, eliminating approximately 1,200 jobs across 23 U.S. locations. The firm took a $52 million after-tax charge for the closure. The announcement used the phrase, "Market conditions have necessitated a substantial reduction." It was a euphemism for The subprime market is collapsing and we have been too exposed to it for too long. What it did not say was that Aurora Loan Services, the other subprime originator Lehman still controlled, was continuing to operate. The firm had closed one door and left the other wide open. At the end of fiscal year 2007, Lehman Brothers still held roughly $111 billion in mortgage-related assets on its balance sheet, including large positions in commercial real estate. When markets moved against those positions, the numbers would move fast. And they would be very, very large. The alarm had been raised, the alarm had been dismissed, and the men who had raised it had been shown the door. The next person who would need to raise an alarm would not get the chance. Chapter 5. The Gorilla in the Room. Richard Severin Fould Jr. was born in New York City in 1946. He attended the University of Colorado and served in the Air Force before joining Lehman Brothers as a commercial paper trader in 1969. He was, by any measure, a remarkable businessman, focused, driven, intensely competitive, and deeply invested in the firm's identity and survival. He had survived things that destroyed other careers. He had rebuilt Lehman Brothers from near bankruptcy after the 1984 American Express acquisition had stripped its spirit. But there was a pattern in how he handled opposition that would prove fatal. Fould ran Lehman as a personal fiefdom. His inner circle, most loyally, President and Chief Operating Officer Joseph Gregory, who had been Fould's closest ally since the 1970s, reflected his worldview back at him. Gregory had championed the aggressive expansion into real estate. He had been the enthusiastic internal sponsor of the strategy to go deeper into subprime mortgages, to originate more, to package more, to hold more on the balance sheet. When Gelband and others raised concerns, it was Gregory who most effectively neutralized them. By March 2007, Bear Stearns, Lehman's closest competitor in the world of mortgage-backed securities, had suffered the collapse of two hedge funds heavily exposed to subprime debt. The funds had wiped out $1.6 billion in investor capital. Bear's near collapse was a visible public warning of exactly what an over-leveraged investment bank looked like when the mortgage market turned. Lehman Brothers senior management watched it happen and did not change course. In the first half of fiscal 2008, Lehman reported a net loss of approximately $2.3 billion, its first quarterly loss as a public company in 14 years. The announcement on June 9, 2008, contained the following statement from Richard Fould. "I am very disappointed in this quarter's results. We had our first ever quarterly loss as a public company. However, with our strengthened balance sheet and the improvement in the financial markets since March, we are well positioned to serve our clients and execute our strategy." The market did not believe him. On June 9, 2008, Lehman Brothers' share price closed at $28.48. 12 months earlier, it had been above $80. The firm had lost nearly two-thirds of its market value in a year and was still falling. Short sellers, investors who profit when a company's stock falls, were circling the firm with open aggression. What almost nobody knew at the time, what would only come to light in the 2,200-page Bankruptcy Examiner's report, was that Lehman Brothers had been systematically misleading investors about the true state of its balance sheet. The mechanism was called Repo 105. A repurchase agreement, or repo, is a short-term borrowing tool. A firm sells assets to a counterparty in exchange for cash, with a simultaneous agreement to buy them back at a slightly higher price the next day. Under standard accounting rules, this is treated as a borrowing, but under Repo 105, the deal can be treated not as a borrowing, but as a genuine sale. The assets disappear from the balance sheet, at least temporarily. Lehman used Repo 105 transactions in the first 2 quarters of 2008 to remove as much as $50 billion in assets from its balance sheet at quarter end, the moment when financial statements are prepared and published. The effect was to make the firm appear to have a leverage ratio of 12.1, when in reality it was 13.9. This is not a minor accounting footnote. For an investment bank that depends on short-term borrowing to fund its daily operations, a leverage ratio is everything. Investors, creditors, and counterparties read those numbers and decide whether to lend. Dick Fuld later testified under oath, "I have absolutely no recollection whatsoever of hearing anything about Repo 105 transactions while I was CEO of Lehman." The bankruptcy examiner found that this statement was charitably difficult to reconcile with the evidence. The examiner found colorable claims against Fuld, CFO Erin Callan, and 2 other senior executives for filing misleading financial statements. Nobody was ever criminally charged, not one. In June 2008, as the losses mounted and the stock fell, the internal coup that several executives had been quietly planning came to a head. Bart McDade led a group of 12 senior executives who had had enough. At a dinner that McDade organized in the second week of June, the group agreed that Joseph Gregory, the president, Fuld's most loyal lieutenant, and the architect of the subprime strategy, had to go. They told Fuld, "Gregory goes, or they go." Fuld's reaction was fury. "This was done behind my back," he reportedly said. Gregory was removed. So was CFO Erin Callan. The changes were too late to address the underlying reality of Lehman's balance sheet. But they signaled something important. By June 2008, even Fuld's own executives had concluded the firm was being managed into the ground. Fuld himself continued to believe, against all evidence, that he could negotiate a rescue. He spent the summer of 2008 in increasingly desperate talks with potential investors and acquirers, the Korean Development Bank, Bank of America, sovereign wealth funds. Each conversation ended the same way. When the potential partners saw the full detail of Lehman's real estate positions, the true extent of the firm's exposure to assets that were declining daily in value, they walked away. On September 9, 2008, Lehman's share price fell 45% in a single day. The firm had lost 94% of its market value since its peak. It was worth in total roughly $2.5 billion, less than the value of the building it owned at 745 7th Avenue. The end was now a matter of days. Chapter 6. 3 days that broke the world. On Friday evening, September 12, 2008, the most powerful people in American finance converged on the Federal Reserve Bank of New York at 33 Liberty Street, a Florentine palazzo in Lower Manhattan that houses one of the largest vaults of gold bullion on Earth. They came because Treasury Secretary Henry Paulson had summoned them. Paulson stood before the assembled chief executives of Goldman Sachs, Morgan Stanley, J.P. Morgan Chase, Merrill Lynch, Citigroup, and the other Wall Street houses, with New York Federal Reserve President Timothy Geithner at his side, and delivered a message that would later be described as one of the most consequential utterances in American financial history. "There will be no bailout for Lehman," Paulson said. "The only possible way out is a private sector solution." He gave them 48 hours. "Come up with a private rescue plan," he said, "or suffer the consequences of a catastrophic unwind." There were two potential suitors still in the room. Bank of America, represented by CEO Ken Lewis, was one. Barclays of London, represented by its investment banking chief, was the other. By Friday night, Bank of America had made a decision that Lehman's team did not yet know about. Ken Lewis had been in secret talks for days with John Thain, the CEO of Merrill Lynch, another investment bank that was staring down the same abyss as Lehman, but was less far gone. Lewis calculated that Merrill Lynch was a better buy at a better price. By Sunday morning, September 14th, Bank of America announced that it was acquiring Merrill Lynch for approximately $44 billion in stock. Lehman had lost its last realistic American buyer before the negotiations had formally ended. Barclays remained. Over Saturday and into Sunday morning, the British bank's lawyers and Lehman's lawyers were drafting documents for what appeared to be a viable takeover. Barclays wanted Lehman's core investment banking and capital markets operations, the parts that still worked. But it did not want the $60 to $80 billion portfolio of toxic commercial real estate assets that had destroyed the firm's balance sheet. For the deal to work, someone would need to guarantee those bad assets, effectively absorb the losses so that Barclays could buy the healthy business. Under the plan that emerged, Wall Street's major banks would pool resources to create a bad bank, a special-purpose vehicle that would take the toxic assets off Lehman's books and allow Barclays to acquire the rest. The banks proposed contributing a combined $5 to $10 billion to capitalize the vehicle. Paulson rejected it. He insisted the private sector contribute more, perhaps $25 to $30 billion. The banks refused. Then came the obstacle that ended everything. Under United Kingdom law, Barclays required shareholder approval for an acquisition of this scale. A shareholder vote would take weeks. Lehman could not survive weeks. Barclays needed a government guarantee to cover the gap. The Financial Services Authority, the British regulator, refused to provide it. FSA Chairman Alistair Darling and his colleagues were not willing to expose British taxpayers to the liability of Lehman's unknown losses. On Sunday evening, September 14, 2008, the Lehman Brothers Board of Directors met for the fourth time in 72 hours. A representative of the United States government addressed the board and delivered the message that Fould, who had by this point been sidelined from the negotiations entirely, had refused to believe was possible. Lehman Brothers would be allowed to fail. At 1:45 in the morning on Monday, September 15, 2008, the firm's lawyers filed the Chapter 11 petition in the United States Bankruptcy Court for the Southern District of New York. The filing listed $639 billion in assets and $613 billion in debts. It was, in terms of the assets involved, the largest bankruptcy in the history of the United States. In 4 separate paragraphs of the filing, the words mortgage or real estate appeared 31 times. Chapter 7, Monday morning at 7:45, 7th Avenue. The sun rose over Midtown Manhattan on September 15, 2008, as it always did, indifferent to what had happened overnight. By the time most people arrived for work that morning, a different New York had materialized around them. One journalist, 3 years into her career, described arriving at Lehman Brothers headquarters on 7th Avenue just before 8 a.m. to go live with the news. "I watch as workers solemnly shuffle out of the building," she wrote, looks of exhaustion and disbelief on their faces. Many were carrying cardboard boxes. Not everyone understood yet what had happened. Some had gone to bed knowing the firm was in crisis. Some had gone to bed thinking a deal was still possible. They woke up to find the deal was dead and they were unemployed. In London's Canary Wharf, at Lehman's European headquarters, employees arrived at the gleaming tower on the Isle of Dogs to find representatives of PricewaterhouseCoopers, the bankruptcy administrator appointed by the British courts, standing in the lobby distributing leaflets. The leaflets instructed employees not to enter into any further transactions, not to execute any more trades, not to do anything except go to their desks and wait. Carlo Battaglia, a Lehman trader in London, arrived that morning and later recalled, "It was a surprise that things stopped so abruptly. Everything changed overnight." Across the firm's 27-country network, 26,200 people were effectively unemployed. Not all at once. The unwinding of a firm this size would take months. But on September 15, 2008, the machine had stopped. In New York, trading desks that had been generating billions in annual revenue sat silent. The computer screens still glowed, the phones still worked. But there was nothing to do with them that would not make matters worse. The Dow Jones Industrial Average fell 504 points on September 15th, its largest single-day decline since the market reopened after September 11, 2001. The S&P 500 closed at 1,192.69, its lowest close in nearly 3 years. But the stock market for once was not the most important thing. The truly catastrophic damage was in the credit markets, the short-term lending networks that banks use to fund their daily operations, to pay their employees, to keep the lights on. When Lehman failed, counterparties across the financial system who had been lending to the firm, or who had complex derivatives contracts with the firm, suddenly did not know how much money they were owed, whether they would ever see it, or which other firms might be similarly exposed. They stopped lending to everyone. Banks stopped lending to each other. Credit ceased. The Reserve Primary Fund, one of America's oldest money market funds with $64.7 billion in assets, announced that it had broken the buck. Its net asset value had fallen below $1 per share because it held $785 million in Lehman Brothers commercial paper that was now worthless. The announcement triggered a run on money market funds across the country. Ordinary investors, who had been told money market funds were as safe as bank deposits, began withdrawing funds at a rate that threatened to collapse the entire $3.4 trillion sector. The crisis that followed would destroy $10 trillion in global market value within weeks. It would push the global economy into the deepest recession since the 1930s. In Europe, the shockwaves would eventually contribute to sovereign debt crises in Ireland, Greece, Portugal, Spain, and Cyprus, countries whose economies were still feeling the aftershocks of Lehman's implosion years later. The United States government responded with a $700 billion emergency rescue package, the Troubled Assets Relief Program, signed into law on October 3, 2008. The Federal Reserve and the Treasury intervened in unprecedented ways, rescuing AIG, guaranteeing money market funds, purchasing toxic assets. The tools deployed in October 2008 had not existed in the regulatory toolkit a month earlier. They were improvised in real time by people who had not anticipated needing them to stop a financial collapse that they had not believed possible. For the 26,200 people who lost their jobs, the government's rescue packages were cold comfort. After the bankruptcy filing, Barclays agreed to purchase Lehman's North American investment banking and capital markets businesses, saving approximately 10,000 positions. Nomura Holdings of Japan acquired Lehman's Asia-Pacific and European operations. The salvage was partial at best. The remaining employees, roughly 16,000 around the world, scattered. Some found positions at other banks. Many, particularly those in specialized real estate roles or structured products desks, found that their skills were in negative demand. Brady Kim, who had worked as an analyst on Lehman's trading desk, later told CNN, "You just didn't know what was going to happen when you got into work on Monday. Were you going to be working for Barclays, some Korean conglomerate? The one option few saw coming was bankruptcy." The legal proceedings that followed were, like everything connected to Lehman Brothers, the largest of their kind. The bankruptcy process, overseen by Judge James Peck, lasted 14 years. It was not until September 28, 2022, more than 14 years after the filing, that Lehman Brothers' estate completed mandated payments to its creditors, eventually returning approximately $1 for every dollar owed. Chapter 8. The Silence and What Remained. Now that you know the full story, now that you understand the sequence of decisions, the culture of denial, the accounting maneuver designed to deceive, the weekend of failed negotiations, and the morning when 26,200 people carried their belongings out of a 38-story building over Times Square, we can answer the questions asked at the beginning. How does a firm that survived the American Civil War, the Great Depression, and the Second World War collapse in a single year? The honest answer is not comfortable for any of the people involved on any side. Lehman Brothers did not collapse because the housing market crashed. The housing market crash was the mechanism, not the cause. Dozens of other institutions were exposed to the same housing market and survived. Lehman collapsed because a series of specific decisions, made by specific people, placed the firm in a position where a housing market crash was fatal. The decision to pursue vertical integration of the subprime mortgage pipeline was Richard Fould's decision, enthusiastically supported by Joseph Gregory. The decision to dismiss Mike Gelband and Larry McCarthy when they warned that the firm was overexposed was Fould's decision. The decision to use Repo 105 to disguise the deterioration of the balance sheet was made by Fould's senior team. As Representative Henry Waxman put it in the October 2008 congressional hearing, in other words, even as Mr. Fould was pleading with Secretary Paulson for a federal rescue, Lehman continued to squander millions on executive compensation. What actually happened inside those walls? Inside those walls, in the years between 2003 and 2008, a firm that had survived for 164 years by being adaptable and cautious convinced itself that the rules had changed. That leverage was not dangerous. That real estate only went up. That warning signs were the complaints of the overly conservative. That the people raising alarms were problems to be removed rather than voices to be heard. Inside those walls, a small number of people collected hundreds of millions of dollars in compensation while building a machine that destroyed tens of trillions in global wealth. Inside those walls, the most profitable engine in Wall Street history ended up fighting for its own survival because the people running it had grown too confident in their own invincibility to acknowledge that the machine was broken. They had every chance to survive. People inside told them how. Those people were dismissed, marginalized, and pushed out. Someone chose not to let them fix it. The building at 745 7th Avenue still stands. It stands between 49th and 50th Streets on the west side of 7th Avenue in Midtown Manhattan. Its 38 stories of steel, granite, and glass rising 575 feet above the pavement. The illuminated crown at the top still glows at night. The 15,000 square feet of LED display at its base still shows the logo of a major bank. The logo is not Lehman Brothers. Today, the building is fully occupied by Barclays. Barclays acquired the building, valued at $960 million at the time of the sale, as the most significant physical asset in the deal. The Lehman Brothers sign that once hung above the entrance was removed, auctioned at Christie's in London, and sold to a collector. Employees of Christie's were photographed carrying it out of the building. There is a particular irony in this. The last serious buyer for Lehman Brothers was Barclays, the same Barclays that now owns the building. It is possible to calculate what the British regulators' refusal cost the world. That calculation runs to several trillion dollars. The Lehman Brothers name survives in fragments. The Harvard Business School Baker Library holds the firm's historical archives, documents going back to the original Montgomery Cotton ledgers of the 1850s. The records of 164 years of commerce, from a dry goods store on Commerce Street to the largest bankruptcy in American history, are preserved in acid-free boxes in Cambridge, Massachusetts. Researchers still visit. The Lehman Brothers sign that hung at Canary Wharf was sold at auction. The sign that hung outside 745 7th Avenue was sold at auction. The mahogany conference tables were sold at auction. Christie's, the auction house, handled much of the liquidation. One of the defining images of September 2008, two Christie's employees standing on a London pavement, holding a dismantled Lehman Brothers sign between them, appeared in newspapers around the world. Neuberger Berman survived as an independent firm, the museum of what remained. As for Richard Fuld, he largely disappeared from public view after his 2008 congressional testimony, in which he told the committee, with his glasses in his hand and a look of apparent discomfort, "I wake up every single night thinking about what I could have done differently. This is a pain that will stay with me for the rest of my life." When he re-emerged in 2015, he was unapologetic. He suggested that Lehman could have survived if the Federal Reserve had allowed it access to a bank charter. He described the collapse as the perfect storm. He avoided any mention of Repo 105. No criminal charges were ever brought against Richard Fuld, Joseph Gregory, Erin Callan, or any other senior Lehman executive. The accountability question is the one that has no clean answer. Was Fuld a criminal? The legal system said no. Was he reckless? The evidence says yes. Was he alone in his recklessness? No, not by a long distance. The ratings agencies were reckless. The regulators were reckless. The Federal Reserve, under Alan Greenspan, was reckless. The Congress that repealed Glass-Steagall was, at minimum, profoundly careless. But of all the people who contributed to the collapse of Lehman Brothers, only two made the specific decisions that turned a manageable crisis into a fatal one. Richard Fuld, who chose to dismiss the warnings, double down on the positions, and deceive the market about the firm's health. And the nameless collective of regulators, politicians, and financial executives who built the system that made his choices possible. The machine they built together, and the machine they watched break together, cost the world more than it will ever be able to fully count. Henry Lehman arrived in America with nothing but the ability to recognize the price of things. He built a business from that ability. Over 164 years, his brothers, his nephews, his grandsons, and a succession of professional managers built that business into one of the most powerful financial institutions on earth. It took Richard Fuld 4 years to destroy what 164 years had built. And it took the world another decade to climb back to where it was on the morning of September 14th, 2008. We want to hear from you. Tell us in the comments where you're watching from. Tell us what you remember about the morning of September 15th, 2008, what you saw on the news, what it meant for your savings, your job, your family. Tell us what surprised you most in this story. And if you had a pension fund, a mortgage, or a money market account in the autumn of 2008, you already know, in a way that no documentary can fully convey, exactly what was lost when the lights went out at 745 7th Avenue.